Hi, everybody. Today is Monday, March 18th, 2024. I am Ashley Wilkin, Senior Wealth Manager with the Rice Partnership, and I have Orest Saikevych here, our Chief Investment Officer. Hi, Orest.
Hi, Ashley. Hello again, everyone.
So the S&P 500 closed near the record highs. We've been seeing quite a bit of a rally this year. Can you start by telling us what's behind the current rally we're in?
Sure. Even though the stock market has continued to rally year to date, we started, this rally in early November. The reason for the rally has changed. Late last year, we had what was known as an everything rally. The thought was that the Fed would pivot by March and we would see 6 rate cuts by the end of this year. As economic data has come in so far this year, and it's apparent that a lot of this economic strength has continued, and the earnings of companies are starting to reflect that, people are realizing that stocks can possibly live with a little higher inflation than 2%. And with the economic strength and with the earnings coming in, stocks have benefited from that.
So the Fed currently has priced in 3 rate cuts this year. Do you agree with that outlook, and what could change it going forward?
Right now, 3 cuts is probably a maximum. It may be less, it may be actually 2. I think we'll find out a lot more on Wednesday, today being Monday, the 18th of March. Fed has a meeting, 2-day meeting starts tomorrow, extends into Wednesday. It'll be very interesting to hear what Chairman Powell has to say, what the dot plots are as far as rate cuts are concerned, and the timing of those rate cuts. So that we should know a lot more Wednesday afternoon.
So given what we know today, are the recession fears behind us for now?
We feel that recession fears have receded, but they haven't gone away completely. Whereas we're at probably a coin flip 50-50 chance for most of the last several months. Right now, it looks like it's more of just a 1 in 3 chance of that. And the reason for that is that the Fed rate hikes, which started in March of 2022 and ended last summer, those rate hikes should have had a bigger bite in the economy by now. Recall, I think in previous videos, I mentioned that the 3-month to 10-year Treasury yield inversion started around Halloween of 2022. Well, we're up close to 18 months now, and there should have been a bigger response as far as the economy is concerned to the increase in the Fed funds rate. To me, that's an indication of an economy that's less interest rate sensitive now than it was in previous cycles. And it's also indication that financial conditions don't seem to be that restrictive. So with the Fed funds rate at around 5.5%, things are not as restrictive as they may have seemed earlier.
Okay, great. Well, we'll continue to follow the economic updates, and we look forward to next month's video with more information. Thank you, Orest.
Thank you, Ashley. Take care, everyone.